This is the future's AutoPilot. It can place real bracket orders on your prop account. So before you touch a single number, understand this. Every setting in here does one of three things. It decides what to trade, how much to risk, or when to stand aside. I'm going to walk you through all of them in the order you should actually set them. By the end, you'll know not just where each switch is, but what it does inside the engine, and the one mistake people make with it. Start at the top. 3 states. Disarmed is off. Shadow is the important one. The agent analyzes every cycle, logs the exact trade it would have taken, and tracks a virtual position book, but places 0 orders. Same gates, same sizing, same exit engine as live. What you read in that log is what would have happened. Armed places real orders. When you arm it, the whole configuration locks. That's deliberate. You can't half-edit a live agent. The rule, never arm a fresh configuration. Run Shadow for at least a full session. It costs you nothing and it catches the wrong account, wrong symbol, no candidate's class of mistake in minutes. Next, the brain. 2 options. Engine is the deterministic setup library. 14 strategies, best risk-reward wins. Predictable, and it costs no AI credits. GAZUM LLM is the discretionary brain. It reads every time frame, the stocks inside each index, macro correlation, bonds, oil, metals, the dollar, market profile context, the moving average ladders, and order flow. Then it decides like a discretionary trader would and runs a second contrarian pass that can veto its own idea. Here's what matters. The brain only proposes. Every risk gate, every sizing clamp, every protective order is identical for both. The brain cannot override your limits. And if the AI provider goes down or your credits run out, an outage breaker hands control back to engine automatically and blinks a red alert in the log. Trading never stops. Pick your account. This does more than route orders. It sets the classification. If the platform sees a funded account, it silently preloads conservative defaults. A $400 hard daily loss, a $900 profit lock, 6 trades a day, a 3-loss breaker, a 10-minute cooldown after a loss, and every edge filter switched on. Evaluation accounts do not get those automatically. If you're on an eval, set them yourself. A failed eval costs a reset fee just like a blown funded account costs the account. Then symbols. Micros, MNQ, MES, MYM, carry 1/10 the dollar risk of the minis. 1 ES point is $50, and a normal stop can be 8 to 15 points. Start with 1 micro. The agent handles the front month roll for you. This section decides how much of a winner you actually keep. Dynamic exits size the stop and target from market structure and ATR and require a 1.2 reward to risk minimum. Leave it on dynamics, it adapts to volatility. Fixed ticks are for testing a mechanical idea. Break even at R. 1 R is your initial risk. When the trade is up this much, the stop moves to your entry, plus a couple of ticks for commissions. It rests at the broker, so it protects you between cycles. Now, the most common mistake in automated trading. People set break even at 1/3 of an R because it feels safe. What actually happens is that normal retracement takes you out of every trade that would have run. You end up with tiny winners and full-size losers. The platform now measures MAE and MFE on every single trade, how far it went against you and how far it went for you, so you can look at your data and see how much room your winners actually need. Default is 1.8 R, and that's a reasonable starting point. Trail follows price at a multiple of ATR, only ever tightening. 2 times ATR is a sensible default. Widen it toward 3 if your data shows winners peaking well above where you exit. Give back guard closes the trade if it hands back a percentage of its peak profit. 40% arming once the trade is up 3/4 of an R. That's the setting that prevents it was up $400 and closed red. Scale out peels part of the position at +1 R and lets the rest run. It needs 2 or more contracts, and you must raise both base contracts and max contracts per order, or nothing happens. Reversal protect is off by default. It only touches trades that haven't reached break even yet, cutting them when the signal flips against them for 2 confirmed cycles. Sizing. Base contracts is what the agent wants. Max contracts per order is a hard ceiling. Effective size is the smaller of the 2. A deliberate double gate, so a fat-fingered base can't quietly triple your size. Max risk per trade is your hard dollar ceiling, and here's why it exists. It's measured from the actual fill against the actual resting stop, not the estimate. On this platform, we measured entries that came in at 154% of the intended risk because price moved between the decision and the fill. Set it, roughly 1% of equity. Vol target risk budget is the professional version of sizing. Instead of always trading 1 contract, the agent computes contracts from your dollar budget divided by the stop distance. Tight stop day and wide stop day then carry the same risk. On prop accounts, it can only size down, never up. A trailing drawdown breach ends the account. No sizing edge is worth that. Daily loss. Stop new entries is your soft break. No new trades, existing ones keep managing. Then the clock. No new entries after 1645, flatten at 1655. The flatten time must be after the no new entries time, and Globex, overnight trading, off. On this platform's own measured history, the overnight session was a consistent bleeder. These are different from everything above. The settings up there stop new entries, these close open trades, and stop the agent for the rest of the day. Daily loss, flatten and halt, the hard break. Keep it inside 20% of your drawdown allowance. Daily profit lock, bank the day. On a prop evaluation with a consistency rule, one enormous day can disqualify your payout. That's what this prevents. Trailing drawdown, pay attention here. Enter your firm's dollar figure. Set the basis to intraday, including unrealized, because that's how Apex actually computes it. Your open profit counts toward the peak. And set a cushion, so you're flattened before the floor rather than at it. The one thing I'd ask you to double check on this whole screen, that the trailing drawdown number matches your actual account tier. A 100K figure left on a 50K account is the kind of mistake that ends an account. Every filter here removes trades. None of them can create one. And if your agent isn't trading, this is usually why the log names the exact filter that blocked each candidate, so you're never guessing. Market structure blocks entries that fight the swing structure. Order flow reads the live tape. Cumulative delta over the last 30 seconds versus the prior 35 levels of book depth and absorption at the tape extreme. That last one catches shorting into lows where a passive buyer is quietly absorbing every seller. If there's no live tape, it always allows. A filter must never halt an unattended agent. Location confluence refuses to chase the auction extreme. No trade and chop stands aside when ADX is below the floor. Day trend guard stops you fading a one-directional day. Tape fight breaker locks one side after repeated counter trend losses. The with trend side keeps trading. An event blackout. The 2026 economic calendar is built in FOMC, CPI, non-farm payrolls, PPI, PCE, GDP with exact release times. 10 minutes before until 5 minutes after, no new entries. Open positions keep their stops and keep being managed. It does not flatten for you. A Fed statement is not a setup. It's a coin flip with a spread. Leave this on. Last section. The agent measuring itself. Set learning mode to shadow on day one. It records outcomes per setup and market context and changes nothing. The panel's honest with you. It tells you when a bucket is statistically supported and when it's just noise. The A/B panel interleaves the raw pick and the learned pick on live cycles and measures realized R of each. That's out of sample proof, not a back test. Don't switch on any money path lever until it shows lift. This strip is the hour of day edge map, your measured expectancy per hour of the day. Green is positive, red is negative, and a red ring means statistically proven. The hour edge veto makes the agent stand aside in ringed hours, but only with at least 12 of your own trades in that hour. We tested a plain 10 a.m. clock rule on real results and it lost money. Learned, not assumed. The self-tuning machine watches for trouble. 3 losses in a row, winners smaller than losers while you're net down, bleeding past half your daily cap, over trading. When it triggers, the agent audits its own trades and retunes settings inside hard rails, measures the result, and reverts the change automatically if it didn't help. A weekly walk-forward replay double-checks each change against your own history and flags disagreements. It can trade less, later, smaller, or more selectively. It can never raise your risk. Finally, credits. The AI brains consume AI credits. This strip shows what's left. It turns amber at 25% and red at 10%, with an on-screen warning, and buy tops you up in a click. Top up while it's amber. At 0, the brain quietly falls back to the rules engine. That's every setting. You don't have to remember it. Click the book icon in the widget header and the same explanations are there, searchable with a quick start checklist in the exact order I just used. One last time, the sequence that matters: account, 1 micro symbol, size at 1, your risk limits, guardrails from your firm's numbers, filters on, learning in shadow. Then shadow for a session, then arm on SIM. Set it up once, properly, and let the machine do what it's good at.